Hello and good day. Welcome to our second monthly webinar. My name is Don Emmett. I'm a certified business intermediary with Murphy Business Sales. And today we're going to be talking about business valuations and why you should have one. If you're working with business owners, why they should have one. So thank you for tuning in and spending some time with us today. Let's get right to the point. Why should we have a business valuation? Well, great question. Glad I asked. There are many reasons for a business valuation. In this webinar, we're going to take a look at the top 10 reasons. So it's Don Emmett's top 10 reasons why you should have a business valuation. So the subject that's near and dear to my heart is succession and exit planning. So even if you're not thinking about doing a third-party transaction, if it's a potentially a family transaction, a gifting to a family member, likely you're still going to need or want a business valuation. How valuable an item are you gifting? Because there are laws and taxes that will come into play. So if you're thinking about exit planning, you or your financial advisor may want to know, as you're making your plan for the future, whether it be another investment in another business, or if you're thinking about retirement, what does that piece look like in terms of your net worth and your total assets? So, or you could be thinking about perhaps a transaction with an insider, somebody in the company, one of your management team, or your entire management team. Again, that business will be valued on a as-is or ongoing basis, and typically that would be a higher valuation than you would do with a family member, much like if it was a third-party transaction. So these things need to be ascertained. So in a similar vein, for gifting reasons, and or if you should pass on at some point, or when you pass on, if you haven't disposed or transferred your company, in order for your executive to file an estate tax return, they're likely going to need evaluation. So for gifting or estate tax, this is one that's probably kind of obvious. If you were to engage in a sale, you'd want to know if you were approached with an offer from an unsolicited offer. Is it a good offer? So it's a great idea to hire a qualified valuation analyst to value your company as opposed to the marketplace, and how do you stack up against your peers in your industry. In a merger situation, generally, both of those companies, both entities will need to be valued. So two valuations likely be needed in a merger. And or if you're thinking about growing your company through an acquisition, it's likely you want to see what the value is of what you're considering purchasing. What would a fair offer be, and be able to back it up with data. So probably the most common reason people come up with for business valuation is for a buy-sell agreement. So this is generally an agreement between partners or shareholders, and or even a single owner should have a buy-sell agreement, somewhat like a will for your company. This kind of lays out how the company can purchase shares of a partner or member or shareholder, if they're on, if for whatever triggering event, they're no longer able to fulfill the necessary portion of their operating agreement or their employment agreement. So if they become disabled, if they move out of the country or whatever reason, or they pass on, this will tell us. It's usually a formula set in place, and it's usually funded by an insurance policy. So in order to know how much insurance we should be carrying to fund the agreement, a business valuation, and update it every few years to ensure that the value of the company and the formulas are tracking and still relevant. There are more reasons. There may be a dispute, or just or a partner leaving or a partner coming in. So if a partner is leaving either on good terms or bad, should be a formula says what their buyout will be over what period of time, and it should specify what type of valuation and how the company is to be valued. So run into an instance recently with the valuation that I did, and two partners were having a dispute, and a minority partner was being asked to leave, and the operating agreement was written a bit vaguely in terms of what was the key metric for valuing the company, and led to confrontation and continuation of a dispute. That a better written agreement and perhaps valuations being done during the process, during the as a regular part of business every few years, would have likely avoided. And also, as we said, if a new partner is joining the ownership team, what's their capital account going to be worth, and how will they pay for that and or compensate the other partners? In the event of a dissolution of a marriage, the assets of the partners are also marital assets. So even if a spouse is not an owner of the company, they have rights and through marriage. So in the event of a divorce, it's likely that the company is either going to have to be valued to determine an equitable buyout of the non-owning spouse, and or potentially, like as I've seen in previous engagements, the owners may be forced to sell the company in order to facilitate liquidity to buy out the spouse. For insurance purposes, so if the owners are pursuing life insurance or disability insurance or key man insurance for an income producing partner, you probably want to have a valuation done to see, again, how much insurance should be covered on the respective partners. In some cases, in my case, in my old business, where we had a significant range of ages among the partners, the younger partners could be insured relatively cost effectively, whereas the more mature founding partner was quite expensive to insure. So a decision was made based on the valuation to self-insure a portion of that. But that's something you would want to know beforehand and not be surprised after someone leaves or wants to leave. So this is somewhat important for tax reasons. Whether you're buying or selling a company, there's tax consequences of how the assets are valued and how they can be written off for tax purposes. So in terms of a sale, the assets are going to convey at fair market value, not necessarily what the value is on the balance sheet, which with today's expedited depreciation schedules could be little or zero for many pieces of equipment that are still have an economic life to them and are still producing product and or generating revenue. So the difference between fair market value and the balance sheet value of a piece of equipment is considered the recapture of depreciation, and that'll be taxed at ordinary income rates. Whereas the goodwill portion of a business purchase or sale is taxed at long-term capital gains rates. So how a purchase price is allocated has significant tax implications. So business valuation beforehand will help spotlight those issues and allow you to go into negotiation of the allocation better prepared. If you endeavoring to acquire financing, perhaps buy a building, perhaps an expansion of your existing building, the SBA is going to require a business valuation and or a appraisal. Likely you'll be using that as collateral for the loan. So you might want to get a handle on now what that, how much you can borrow when you're looking at a potential expansion of your business. Employee stock ownership plans. So this is when the owner or ownership group sells the company to its employees, the employee owners of the company. In this case, evaluation is needed before that's done, and then every year following. Evaluation needs to be done to price the shares of the employee stock ownership plan. So how does one go about getting evaluation, and what's involved? So a little insight into how companies are valued. In our world, in Murphy Business Sales, we use a triangulation of 3 different methods. The idea of valuation, although the way we do it at Murphy is significantly data-driven, there is still a bit of art and experience to the process, and somewhat of a sanity test at the end to see, given a certain business's track record and financials, what would a knowledgeable buyer be willing to pay for that that investment? We and anyone would do a thorough recasting of the financials to get a true picture of the benefits the business is bringing to the owners. Get more into that later on when we talk about sellers' discretionary earnings and EBITDA. We would advise you be aware and beware, be afraid of rules of thumb. Okay. What's your neighbor's business sold for, or the multiple that someone else used, or someone said, gee, I heard these businesses sell for 5 times sales. Is that true? Generally, no, that's not true. So it depends on cash flow, which we'll get more into in a moment. So the bottom line is how much cash flow, how much earnings can the buyer expect? The business to generate to pay compensation, to cover debt service that may be taken on to purchase the business? What investments are needed to make on an annual basis to maintain the business, to maintain the machinery? How long does the machinery last? How often do they have to be replaced? So capital expenditures are going to come out of cash flow. And as an investment, it needs to provide a reasonable risk-adjusted rate of return on the investment. And our experience has told us that for small businesses, given that it's a very illiquid endeavor, probably the down payment that's invested probably needs to generate at least a 30% return on the invested capital. So, a little more an overview of how we do evaluation at Murphy. We do several methodologies, a market-based approach. We do a qualitative approach and a buyer's test. But to, as we say, something is worth generally what somebody's willing to pay for it. And that is found out in an arm's length transaction by a knowledgeable buyer and a willing seller. A little bit more look at the process. We generally review 3 to 5 years of tax returns, recasting those financials to determine the seller's discretionary earnings or adjusted EBITDA. People are probably more familiar with the term EBITDA, earnings before interest, taxes, depreciation, and amortization. Generally, that's a figure used for larger companies that has professional management in place. For our discussion, the difference between EBITDA and seller's discretionary earnings, for the most part, is the owner's compensation. So seller's discretionary earnings is assuming that the owner is drawing a salary of market-based compensation. And that's, we would add that back to net income. So here are the definition of seller's discretionary earnings, or SDE. We start with pre-tax net income, and to that we add the interest expense, because to make the someone may have a different capital structure and may not have an interest expense, so we want to have a level playing field. So we add back the interest. Depreciation as a non-cash expense is added back. Amortization is the write down of intangible assets, also non-cash. It's added back. We add back one owner's reasonable salary. And kind of, we also sometimes look at what's the marketplace saying, what would a general manager be paid to undertake that job. You can also add back any verifiable expenses that were spent on the owner's behalf, such as personal health care, life insurance, disability insurance, personal vehicles, family cell phones, things of that nature. Again, discretionary here being the key word. Things that another owner would not necessarily have to show as an expense that could be cash flow or net income. We're also going to recast the balance sheet, particularly before we do a transaction. We're only going to offer those assets that are be involved in the transaction. And most small to medium-sized transactions are asset transactions. Asset sales, you're generally not selling the balance sheet or the entire company. It's the seller's entity, their corporation or their LLC, selling the assets, specifically the specific assets, the operating assets of the company, to the buyer's entity. So that includes inventory and furniture, fixture, and equipment. Generally, cash, accounts receivable, and accounts payable will not be part of the transaction. Those will stay with the seller and not be necessarily part of our valuation. So these are the three methodologies that we use: the market-based approach, where we derive a multiple after analyzing comparable market sales in the industry using one of the services that we subscribe to. And we derive through regression analysis the appropriate multiplier. I'll show you a little bit more about that later. Second approach is speaks to the quality of the earnings stream. We have 10 different variables that we rate from 0 to 3 on such things as historical profits, the attractiveness of the business, the attractiveness of the location, the demand for businesses of that nature, the financial possibilities, the financing. Will we be able to offer a good financing package to a prospective buyer? Then we look at a reverse methodology called a buyer's test, which takes into account the compensation that a buyer would be able to pay themselves, the amount of capital expenditures that are needed on an annual basis, the amount of debt service they're going to have to take on and pay on an annual basis, and then to see if that meets the criteria of a reasonable rate of return. Again, probably needs to be at least 30%. And we'll see what would a buyer be willing to pay for a stream of income of that nature. So to recap, what makes a company valuable? Cash is king. If you're an owner-operator and the business needs you to be there, you may be self-employed as opposed to having a business. And that's going to detract from valuation. So if there's a management team in place that can take over and allow you to go on vacation and get away, that's a more valuable company. Clean financials, a well-run accounting system that accurately reflects the business, how the business is progressing and has performed over the years. Broad customer base. Why is this important, you might ask? Well, if there's a extreme customer concentration, that's a riskier business. So ideally, business that has no one customer that counts for more than 10% of the business's revenue is more valuable because it's less riskier than a business that one company or one customer accounts for 30, 40, 50% of the revenue. If that customer is lost or doesn't convey through the sale, you've just lost half of the revenue of the company. So steady growth. People like to see a nice left to right graph on the sales and revenue. Hiccups, ups and downs, like we're experiencing right now, are not as comforting to a prospective buyer, and it's going to decrease the valuation of the company. And recurring revenue is valued more highly than project-based or intermittent revenue. So contracts that will continue into the future, that's steady income. So it's will increase the valuation of the company. And ideally, there's some sort of a competitive advantage that the company maintains. That is why they've been successful, and that advantage will be able to continue into the future. Here's just a little insight into how we do the figure out our multipliers using regression analysis. So the plots, the dots, the data points on both these graphs are actual transactions. They're actual sales. On the top, we have price on the x-axis, and seller's discretionary earnings on the y-axis. So it's price divided by SDE. And we can see that the slope of the line is in fact the multiplier. How, in order to generate $1 million sale price, we can see from this chart, the company would need to be generating about $600,000 in SDE. And we could see on the below chart, the price divided by revenue. This kind of speaks to the rules of thumb approach. This is a much more scattered diagram, and the data does not, it's not relevant to, the price divided by revenue is not a relevant determinant of value, because of it doesn't correlate to the line going across. So that's going to be about all for us for now for this webinar. Thank you for tuning in. My name is Don Emmett. I'm a certified business intermediary with Murphy Business Sales. I'm the owner of Murphy Business Raleigh South. So if you'd like to discuss any of these terms or slides in greater detail, please give me a call at 919-881-9997, or you can give me an email at d.emmett@murphybusiness.com. Thanks again for tuning in. All the best to you and yours.